Hey everybody, happy Thursday. Today we're going to discuss the difference between active portfolio management and passive management, a question that comes up a lot. So what is active portfolio management? Well, typically, if you look at your typical fund or managed portfolio, there's a portfolio manager. That means it is actively managed, meaning that somebody is at the helm of the ship deciding when to buy, when to sell, and what to buy and what to sell. Passive management is the exact opposite. Index funds, ETFs like the SPY or the QQQ, where you're buying an entire index, or certain thematic trusts like unit investment trusts or ETFs that are specific to a theme. And whatever is in there, that's what's in there. You are going to be mimicking a certain sector or index. Now, despite the fact that mutual fund managers struggle to beat the market, most don't, they still control the lion's share of the fund assets out there. Indexing is a much simpler approach. There is, of course, a lower fee structure because you don't have as many costs paying a portfolio manager. There's much lower turnover, so there's going to be fewer capital gains taxes. On the negative side, however, you own all the stocks in that index, and some of them you wouldn't buy on a bet. So, as opposed to the passive management where you're betting more on the horse than the jockey, with the active manager, you're betting more on the jockey than the horse. It's much more of a hands-on strategy. So, which is better, active or passive? And the answer is, of course, it depends. So, the best thing to do is diversify and have a blended portfolio. So please go to my website, jlaloof.com. You will find a lot of cool stuff there. Under resources, you will find newsletters, articles, calculators, flipbooks, etc., including this particular article with this chart that shows you the difference in assets between active and passive management over the last 10 years. And you can see that back in 2009, the lion's share was, of course, active management, whether it was mutual funds or money managed accounts, 82%. 10 years later, that's down to 61%, but yet they still have the lion's share. Please, again, go to my website, jlaloof.com, where you'll find a lot of interesting things, including our newsletter, the Aloof Matos Report. Thank you for watching today, and make it a great day.